Return of capital, better known as ROC. Is it good or bad for retirees? I'm going to explain it all today. Hey everyone, welcome back to the channel. I'm Doug, the retirement guy, and I've been retired for well over 10 years already. If you don't know my background, I retired when I was basically 50 years old, and I've been studying, living off of dividends for 10 years already. Haven't hit Social Security, haven't done any of that yet, but I've been living off of retire with the dividends and just enjoying life. So I had to learn this. ROC was a big thing that I had to learn when I got into this. And when I first read it, I'm probably like everyone else, return of capital. This is a joke. I ain't getting my money back. Well, we're going to help you through this whole thing. I know I've done this video before, but we're really going to put this more towards the retiree side of it. Is if it's good for you or bad, how does it all work? Let's get into today's video. But before I go any farther, I do have to do the important disclaimer. And this presentation is for educational and informational purposes only. Nothing here constitutes personal finance advice or recommendations to buy, sell any security. Past performance does not guarantee future results. Always contact a qualified financial professional before making those investment decisions. Now, the ROC misconception. The return of capital, better known as ROC, and I'm going to use ROC pretty much for the rest of the show, is one of the most misunderstood terms in retirement income investing. Many investors dismiss it as just giving me my money back, and I'm not interested in doing that. But the truth, it's more of a tool, but it can be a double-edged sword. It can be used in two different ways. And that's why you got to be concerned about it. You got to know what you're talking about. You got to understand the whole package. It's a smart tax tool. It can be a highly tax efficient way to receive income, deferring taxes until the investment is virtually sold off. Now, a warning sign and a signal that your ROC is very destructive is where a fund is slowly eating its own principal to maintain unsustainable yield. Now, no one's going to put a flashing notice out there. No one's going to put this notice to say, oh, we're the bad ROC or we're good ROC. What we basically did is we came up with a brilliant idea how to create that return of capital to help you and your tax side. But again, you give something good to somebody, the negatives are going to come about. So I'm going to tell you up front, this is a double-edged sword we're going to work with, and I'm going to teach you how to see the signs so you can stay out of those muddy waters. So the key question in some of the brief answers, what exactly is return of capital? Okay, why do income ETFs use it so often? Why is ROC good for retirees? What happens when it does come dangerous, and how do you tell the differences? Well, let's answer all these questions for you. Well, first off, part one, what is return of capital? And the true definition of it is return of capital, ROC, occurs when a fund distributes money classified as return of the investor's original investment rather than earnings. The common sources of the distribution is corporate dividends, realized capital gains, and option premiums from covered calls. The key test is always the NAV, the net asset value. If you've ever watched any of my videos, you'll always see I talk about the assets. I'll talk about how big the assets are. It's not to talk about how great a fund is because they're in the billions or multi-millions, but what it is it sets a benchmark. It sets the benchmark because if you're actually returning my capital, I'm going to watch those assets slowly drop off. And it will tell you that you're going in the wrong direction. You're moving into the wrong spot. So in scenario A, tax efficiency, distributions are paid while the NAV remains stable or actually grows. This suggests the fund is generally strong enough through its total return to cover the payouts. And that's the other thing we're going to talk about is that total return number. That will tell you a lot what's going on. Scenario B, the destructive side. Distributions are paid, so you're still getting your yield and you're still happy. You're still getting your paycheck. But if you don't pay attention to it while they're paying you that money, The NAV is slowly falling year after year, a little bit every month. You're watching it drop and drop. This is a warning sign that the fund is eating itself alive to maintain that yield. So what is the capital return? It really classifies your money coming back to you. If it really is your money, then you're going to be in scenario B. If it's using tax efficiency, you're in scenario A. Number 2, why retirees care about the ROC. Well, you're replacing your paycheck. When you're in retirement, before you go into retirement, you're getting your company check, you're getting, whatever you were doing to generate your income, you're getting your paycheck. When employment income stops, the portfolio becomes the primary source of your life funding. Okay? 10 years ago, when I left my corporate job and I turned around and said, I'm retiring, I'm being done, I'm all set, I did that. Paychecks stopped coming in. I now started living off my income. High yield ETFs are giving you the 8 to 12%, some are even higher than that, are highly attractive for cash flow of that monthly payment. That income consistency is vital for retirement budgeting and stability. However, distribution yield is only half of the success equation. The tax treatment is a very, very important factor. So here's the difference that we have in what different funds come into. The income type. Ordinary income is exactly what it says. It's taxed at the highest possible rates. It's just like getting a regular check. It's ordinary. Qualified dividends will be lower rates at that 0, 15, or 20% level based on your income. Section 1256 that you'll hear about is a 60-40 blend of long-term and short-term gains. No matter how long you've held the fund, comes right out. The first step is 60% of your distributions are going to be classified as long-term gains, which classifies you up like a qualified dividend, 0, 15, and 20. And then short-term comes into play. And then ROC, which is one of the biggest that they use, is that potential tax deferred. You're not paying taxes in the current year. You're kicking the can down the road to either A, when you sell your funds, or you zero out your valuation. So the bottom line, non-destructive ROC can significantly lower your current tax drag, but your portfolio destruction is never a fair trade for tax efficiency. So where we go to why we care about this is because most of the time you're going to have to pull money out of your IRA, your Roth, and you're going to be sitting it up to where you're going to be in a brokerage fund. And money that's generated in brokerage funds is going to come out to you 9 times out of 10 is one of these 4 categories. Most of the time I'll say it is ordinary income. ROC helps defer this down the road as you get farther along. Number 3, how ROC can be a tax efficient. The tax deferred I've talked about, it's to maximize your current income. On the cost basis, the reduction example, on your initial $100,000 investment, let's say you get $6,000 of ROC distributions. What it basically does, it takes that $6,000 away from the $100,000 on paper, not from your pocket, not your value. Takes $600,000 or takes $6,000 away. Your new cost is $94,000. So realistically, that $6,000 was your own money coming back, correct? So federal government says I can't tax you when you're getting your own money back. So there was really no taxes on that $6,000. But your investment cost is $94,000. Hopefully you understand that. It's not your value, it's your cost. So let's say the fund didn't even go up any. It didn't go up any. Your value of your fund is still $100,000, but your cost now is only $94,000. So you keep more today. Your taxes on the ROC portion are pushed to future sale rather than immediate income. Okay? So you're going to have to zero out your $100,000 investment before you have to worry about paying taxes on those select distributions. Now, the tax drag reduction, the lower the current year tax liability leaves more cash for monthly retirement budgeting. Okay? So you're going to have more money to work with in this type of an ROC system. So because you're lowering your current tax liability, okay, because you're not paying taxes on the money coming back in an ROC. The income management, it helps retirees manage their taxable income brackets and Social Security taxation. So you can actually work and say, hey, I'll take more income from a particular fund that's paying ROC versus something that's paying ordinary or qualified funds, that you can actually help move your taxability liabilities across the money. Now, right off the bat, I'm going to tell you this. I don't want everyone to think this. Tax deferred is not free money, but the lower cost basis means a larger capital gain when you eventually sell. And because you're probably going to hold this thing for more than 12 months, you're going to be in the long-term capital gain, which you can actually get that to a 0% as well. But I highly always recommend you talk to a tax advisor when you're getting into those realms. Now, when does ROC becomes very dangerous? And this is why you leave the door open for some problems. Over distributions. Okay? When a fund pays more than it earns or a strategy can actually support. The principal erosion under the surface, the NAV, or that net asset value, keeps dropping. High yield trap. High yield looks great, but you are literally receiving your own money back. Now, this one's happened a lot, and you see this in a lot of weekly ETFs. It's really where it came out big time. So let's take a look at this. Here's my example. I kind of put this on the screen. If you have that initial $100,000 investment, right? And it's advertised you're getting a 15% yield. So you're going to get a $15,000 income. You're happy with that. You're really excited. But the problem is at the year end, your fund is only valued at $82,000. So now you're taking a look at this. And again, I'm not even going to turn around and say that we're just reducing your cost. What we're saying is the value of your fund is only $82,000 at the end of the year. Your $15,000 that you took and put in your pocket, the total account value dropped by $18,000 despite receiving $15,000 of income. This is where it's very, very dangerous. So if your fund dropped $18,000, you got 15 of it. What happened to the other $3,000? Where did that go? It disappeared. It's gone. You have a fund that's losing value. This is when ROC is bad because they legally can give you, they can keep advertising 15%. They don't have to tell you about the drop off. This is why we always talk about total returns. So the retirement danger is once a portfolio shrinks too fast, it becomes harder to recover. Future income potential weakens as the asset's base disappears. Now, number 5. The big test, monitoring the NAV. The yield tells you exactly what the fund is currently paying out. The NAV tells you whether the fund is successfully holding itself together. And total return tells you whether your investment is actually getting ahead or not. I am more into the total return piece of the puzzle. Okay? I want to look at total return. And what I always say is you take your total return and then you take the yield away from it to see how much you're getting from growth. If you're in positive numbers in total return, more power to you. Okay, but if you're sitting there saying that your yield is higher than your total return, you have a problem. It's almost that simple. But watching your NAV over time, you can just track that in a quick spreadsheet and say, hey, this month it was so much money, next month so much money, and start watching if it drops down. The NAV trend while paying distributions. If a NAV is stable, you got a good sign. So if you're seeing the thing, staying at we'll say $100 million, okay, you're perfectly fine. It's going to drop a little bit when it does pay its distribution, but it should come right back up, within just a few, what they call the recycling through of it. So if you pay off in the first, by the fifth, if it's back up to where it was, okay, you're fine. If the NAV is growing, you're even better. So if you take a look at a fund that says it's $100 million and it pays its distributions and it's already up to 102 million, you're fine. You're growing. But when the NAV is falling year after year, red flag. This is why I track my stuff on a fairly regular basis. And when I say fairly regular, I am pretty much almost every single month that I'll watch and record. I'll just watch and record, watch and record. And I'll sit there and watch the NAV and put it in a spreadsheet where the NAV comes down and back up and down. Try to get it almost on the same day every month if I can. So it just makes things easier. But if the fund pays a 12% yield, what's the total return? I don't even care what the yield is. I will never buy something on a yield. I do not watch that. Is the fund pays that monthly income? What's happening to the NAV? Just like I said, did it go down? Of course it's going to go down when you pay. Is it coming right back up? How long does it take to come back up? And does the fund use ROC, which most of them do? This is a tax efficient, or is it a destructive tool in that toolbox? So let's take a look at this one. This actually came from one of my Patreon supporters. He was questioning different things about his portfolio. We do this for people on the select funds that will sit and talk for an hour about your portfolio. And what we found out was this. He bought TSYY because he said, I'm going to double my money. 260% yield. I'm going to double my money. I'm excited. I'm doing really well with it. And I had to chuckle and laugh. I said, QQQI. I'm making 13.64% yield. Without knowing anything at all, ask yourself, which one would you buy? 260% yield or 13% yield? And most people commonly will say, yes, I'll buy the 260. When I sit down and say, let's look at total return numbers. Now we look at our chart. In the blue is QQQI. That fund is 23.48% in total return numbers. If you take that number minus your yield, you're going to come up with about a 9 to 10% difference, which means you'll have a 9 to 10% growth over the past 12 months. When you take TSYY, 260%, you're going to double your money. You're 100% right. You're going to double your money. But what you actually did, you take your total return negative 5.72 from 260. That means you have actually, the fund has lost 265 percentage points. Okay, the fund has dropped. You can see where it was in the positives. Now it's in the dumpster. You've lost money. Don't forget about yield. That doesn't mean nothing to me. You have actually lost 5.72% of your total money across the board. Just from looking at the total yield, the total return numbers and knowing the yield, I can tell you if a fund's good, bad, or ugly just right off the bat. And you should be able to do the same thing with that simple little mark. If you're a positive total return, and you know the yield, you know if you're growing or you're getting small. If this number here was blue and it was 13.65%, you know you're not growing, you're just getting the 13% back of the yield. Hopefully that helps you a little bit to give you a better idea of total returns. Now, ROC is not the same in every fund. This is a big thing, and this is why people have to understand this. Option-based ROCs, common in covered calls or derivative-based income ETFs, often a technical accounting classification for premiums. Does not necessarily mean the fund is losing money. NAV can remain stable and grow while generating ROC. Managing the policy of ROC, the fund targets a steady monthly payout regardless of its earnings, used to smooth out income volatility for retirees. It's dangerous if the fund pays more than it earns in long term and can lead to periodic NAV decay if not carefully managed. Okay, so you really have to understand what is it used for, how is it using it. If it's used for tax purposes, phenomenal. If it's used to keep building up yield, you got a problem. Okay, judge by the results, not by the labels. Capital health. Is the fund maintaining or growing? As I talked earlier. Is the total return? Again, total return is everything, guys. Total return. If the returns is positive after all the distributions are accounted for, you got a good fund. Stability, can the current strategy support the payouts? And the strategy logic, does the ROC align with the fund's stated investment goals? You can't just buy a fund, just pick and choose, oh, this guy said this was good, buy it. You have to know more about it before you invest your money. Number 7, accounting location matters. Taxable brokerage accounts. If an ROC is the most valuable in a tax brokerage account because it defers your tax liability to future dates. It reduces your cost basis instead of generating immediate ordinary income tax. The strategic tool helps retirees manage their tax brackets and Medicare premiums. This is huge, okay? That you can use your money to prevent yourself from paying big Medicare premiums. And also it reduces the tax drag on monthly income, allowing more compounding today. Now, traditional IRAs, it's really irrelevant. All the withdrawals are taxed as ordinary income, regardless of whether your distributions are ROC or dividends. They don't recognize it any different way. And in the Roth, qualified withdrawals are already tax-free. So the tax deferral benefit of ROC provides no additional advantage in this fund as a shelter for the environment. So really, if you're looking at ROC, you want to be in the brokerage side of things. You really don't want to put them in your IRAs, and in the Roth, it doesn't really matter. So this is just an efficient way of how to use it and make sure you're using it properly. Now, the retirement income trap. Now, the dangers here and the lure that comes into investors see a 15% yield on that monthly income. And the ROC is mistaken as free tax benefit without checking the NAV. Okay? It's the psychological comfort of a paycheck masked as a portfolio decay. The trap, the tax-friendly income is useless if the principal vanishes. Sustainable and reliability. Income must be supported by a strategy, not capital return. Preserve the capital to ensure it. Make sure you're using the ROC as a tax advantage. It's really watch your total returns and your NAV. Total return is the ultimate metric in investment success. That's why I repeat it over and over and over and over and over. Sustainable income that lasts 30 years, yield traps fail early. I wouldn't be able to do this for 10 straight years without Social Security or anything like that if I didn't understand the total return number and how this all works accordingly. I would rather have an 8% yield with a healthy NAV than a 16% that's collapsing. And personally, guys, I'm honest with you. I don't have anyone supporting me. I have no one sitting here paying for these videos to be done. I can tell you the truth. I've had the 16 percenters. I've had the big 40 percenters. I've had the TSYYs. Okay? And I've learned from my mistakes. That's why I do these videos, to help you so you don't have to make the same mistakes I did. I'd rather have an 8 percenter and know what's going on than a 16 percenter down the road. So my 7-point evaluation checklist: check your NAV trend. Is the fund's net assets stable, rising, steady, or falling? Verify your total return. I really should almost tell you that's number one. Did the fund actually make money, or is it just a distribution payout fund? Distributions, are they consistent? Is paying out realistic a strategy, or does it look too good to be true? Understanding the strategy. Does the fund use covered calls, index options, linked notes, ELNs? Do you understand those? Review the tax documents. Every fund has to set up a 1019A during the year, and that confirms the final value status at the year's end form of what their ROC actually was. I saw one fund that all year long was 82 to 85% ROC, and at the end of the year they turned around and changed it all and said it was 19%. Huge differences. Compare similar funds. Evaluate against the other peers. How does it work? That's why you see me doing all these comparison videos, because I'm comparing apples and apples and funds against funds. And match it to your account type. If the ROC benefits make sense in a specific bracket, make it happen. taxable versus your IRA. Number 10, good ROC, bad ROC. Tax efficiency ROC is awesome. The fund maintains a stable growth, and the net assets is growing. Total return is a positive after accounting distributions. ROC classifications serve as deferred income taxes to the future, and distribution is supported by underlying strategies or gains. If you have a destructive ROC, your net assets alone will be dropping off on a regular monthly basis. Total return is weak, flat, or actually negative. Again, why I say look at total return immediately. The fund is returning your own money while the portfolio is shrinking, and the yield trap hides itself in that environment. Those are the simple, quick tests to test, are you doing the right thing or not? So my final thoughts and action calls here is this. You got to judge by results. You can't watch a YouTube video. You can't watch your cousin, your uncle, your nephew who's got into all this stuff. You have to do your own homework. Don't judge a fund by a label. Focus on total returns and the NAV stability. Your portfolio is your paycheck, your inflation fighter, and your long-term safety net. Tax efficiency ROC is the most powerful tool that we know, but it can be very destructive if it's hiddenly draining your lifestyle. Okay, for your next steps, measure. Check your 3-year NAV trend of your income of that ETF. Compare it to the higher funds, the higher yields, and also check that total return. Retirement should be made easy. I invented a coffee cup that said, hey, let's make it easy. But we still have to be built the smart way. Guys, let me know what your thoughts are. Leave a comment down below. Hit that like button if you like what we're doing. And most of all, make sure you're part of our family and hit that subscribe button. We'll catch you next time.